In this quick accounting tutorial, we're going to be looking at how to allocate the cost of a plant asset when we buy multiple assets at the same time. And this is called the relative sales value method. So again, the lump sum purchase of assets is when we purchase several assets in a group at one time. The total cost has to be allocated based on their market values. The technique we're using to allocate the purchase price to the individual assets is called the relative sales value method. We're going to be using a real house sale to illustrate this relative sales method. So this is 121 Crane Avenue in Kent, Ohio. It was recently sold to an investor. So if we look at the public record for this sale, we see that on March 9th, it was sold for $55,000 to Stack Investors, LLC. So in this purchase of 121 Crane Avenue, two assets were bought, the land and the building. These items are treated differently for depreciation. Land is never depreciated, so we need to keep that in mind. That's why we need to allocate the purchase price between land and the building. So let's go over some facts and assumptions. We're using some facts, and where we don't know, we're making some assumptions. So the real estate was purchased for $55,000 on March 9th. Let's assume that the land is appraised at $13,650. Let's also assume that the building appraised at $77,350. So if we add those two appraised values together, it totals $80,000. But the purchase price was $55,000. We need some way to allocate $55,000 to the two things we purchased, the land and the building. So let's talk about what would happen if we use the appraised value for our journal entry. So on March 9th, when we purchase this, let's assume that we erroneously put the land in for $13,650 and the building for $77,350. So then we know we paid cash at $55,000, and that can't work because the debits total $80,000, the credit's $55,000. We will be out of balance, so we cannot use the appraised values for that journal entry. So here's the process we're going to use to do this. Let's go through a new example now. So let's say we have land and building. The land appraises for $20,000. The building appraises for $105,000. Along comes a buyer and they purchase the land and the building combined for $80,000. So how is the buyer going to handle this? So the first thing we'll do is we'll list the land and the building, the appraised values, and add those two together. So we get $125,000 as the total appraised value. So next what we need to do is calculate what percentage of the appraised value land is and what percentage building is. So to get the land, we would take $20,000 divided by $125,000 to get 16%. For the building percentage, we would take $105,000, that's the appraised value for the building, divided by the total appraised value of $125,000, and we get 84%. So those are the relative weights of what we purchased. Next, we can allocate the purchase price of $80,000 to the land and to the building. Land, we would take the purchase price of $80,000 times the weight of 16%, and we get $12,800. For building, we're going to take the purchase price of $80,000 times the weight of $84,000, and we get $67,200. And if we add those two together, we get $80,000, which is exactly what we wanted to get because that was the purchase price. So what we're going to see in a journal entry is, first of all, we're going to book the land for $12,800. Next, we'll book the building for $67,200. And those two combined equal $80,000. Our cash that we paid is $80,000. And this method that we have used is called the relative sales value method. Okay, that's it. We're done with this one. This video was created and narrated by Dr. Wendy Tietz. Have a great day.